Joining us today is Ms. Grace Ho, Interim Head of Retail Wealth Distribution Asia. Thanks, Grace. So, what are the potential impacts to broad asset classes amid geopolitical conflict?
On equities, given weaker economic growth momentum, coupled with ongoing geopolitical uncertainty, we expect equity markets to experience heightened volatility. However, markets with significant exposure to energy and materials as inflation hedges and consumer staples as a defensive play may find some insulation thanks to higher commodity prices. Now, within developed markets, US equities are favored over their European counterparts, as we believe the US will be minimally impacted by sanctions against Russia. Their energy and defense industry should expect to see higher substitute demand. Within emerging markets, we are relatively more positive towards select Asian equities, such as Indonesia, Thailand, and the Philippines, considering these are commodity exporting markets. On fixed income front, we think that bonds look more favorable as the prospect of aggressive rate hikes is now lower. Assuming current geopolitical events and stagflation do not lead to a severe recession, we believe the US high-yield market has the potential to deliver relatively better performance versus risk assets like equities, as it is better compensated by higher coupons under rising inflation. Besides, US high yield has a lower default potential versus other regions, as these bonds have a relative greater exposure to oil and gas sectors. Meanwhile, China renminbi government bonds, given the stable exchange rate and high coupon rates, and preferred securities that offer higher coupon rates are also expected to be more resilient than risk assets. Other income-generating asset classes, such as REITs, will be supported, as the spread between US 10-year treasuries and REITs yields should narrow at a slower pace than before.
And how can investors reshape their portfolios with ongoing market uncertainty?
Considering the odds of slower growth and higher inflation are increasing, investors should think about active management and diversification. We believe a globally diversified portfolio, especially with a broad mix of asset classes and geographic regions, could help manage downside risk.